Good day, my name is Adrian Meager. I am the Chief Investment Officer and Managing Director of Orion Investment Managers. There are numerous approaches when it comes to selecting shares, and today I'd like to expand on two of them. The two I will discuss in more detail are bottom-up and top-down investing. So let's start with bottom-up investing. Well, in this approach, the investor examines individual companies based on their fundamentals. Investment fundamentals are the key metrics or principles that would help investors evaluate the performance and value of a company. Examples that you could look at would be profitability of the company, the cash flow, revenue, etc. The investor would analyze company-specific factors, for example, the management team, the earnings growth potential of the company, the price-to-earnings ratio, and they may visit the company headquarters, the factories, or engage with the management team. They could also read research reports from investment analysts who cover these companies and try and value the company or its share price. Well, bottom-up investors believe that companies with strong fundamentals will perform better regardless of the overall market conditions or industry trends. This approach is frequently used by investors who follow a longer-term investment horizon, and they have the expectation that companies with strong fundamentals will outperform the broader market over time. In contrast, a top-down investment approach focuses on macroeconomic factors to understand what is happening or expected to happen in a broader market. These macroeconomic factors will affect a region or a large part of the economy rather than just an individual investor. Some examples of macroeconomic factors that would be considered are economic outputs. These could be examples: gross domestic product, unemployment rate, inflation, and interest rates, or changes in exchange rates. The investor would examine the different macroeconomic drivers and then assess the performance of the various industry sectors based on the expectation of these factors. For example, the investor would try to understand what impact interest rates going up and the economy slowing would have on different industry sectors. Top-down investors believe that if a sector is performing well, then the company's shares within that sector are likely to do well too. And conversely, if the sector is expected to perform poorly due to macroeconomic factors, then the share price is also expected to decline. Acorn, Palmyra, and Capita Asset Management, who are all owned by Orion Investment Managers, integrate both approaches in their equity and multi-asset unit trust funds. They utilize top-down analysis to provide a quarterly macroeconomic framework, which is then applied to their strategic asset allocation decisions, while using bottom-up fundamental research to focus on selecting high-quality individual investments. Remember, there's no silver bullet when it comes to investing, and we believe that successful investing involves blending these two approaches to make informed decisions and manage risks effectively.